we've got 8 monopolies today.
The best businesses in the world. It doesn't get any better than that.
The ones we're going to tell you about today are hidden in plain sight. And these companies, they just don't compete. They dominate their niche through scale, infrastructure, data, or regulation. And once you understand their moats, you start to see why they compound wealth over time.
Turning trash into cash, kind of one of my favorite ways to collect dividends.
Hello everyone, it's Brad Thomas and welcome back to the Wide Moat Show. I'm joined today with my co-host Nicholas Ward. Nick, it's great to see you today.
Yeah, great to see you. Happy to be here. I know today's show is something that we both like to talk about, monopolies. So, the best businesses in the world. It doesn't get any better than that. So happy to spend, the next 30, 35 minutes talking about some of our favorite companies here.
Yeah, so we've got 8 monopolies today. So we're going to kick it off 4 and 4, 4 for me, 4 for Nick. Of course, last week I dedicated that show, or we dedicated that show to real estate investment trusts. As many of you know, some of the most powerful businesses in the world aren't just monopolies like the big tech. I know we're seeing that in the news a lot right now. But the ones we're going to tell you about today are hidden in plain sight. And these companies, they just don't compete. They dominate their niche through scale, infrastructure, data, or regulation. And once you understand their moats, you start to see why they compound wealth over time. Let's break down the 4 of these right now. So Nick, I guess let's start with you, then we'll go to me. We'll go back and forth. Okay. And can't wait to hear your first monopoly pick today.
Yeah, so this was a fun episode to prepare for. There are, I don't know, I'd say 15, 20, like what I would consider probably the strongest monopolies in the world. But, kind of looking through them, I wanted to pick 4 that I think are still really strong moving forward. Some monopolies in the past, Visa, MasterCard, for instance, they dominate the digital payments space, but sometimes monopolies become so strong that, political pushback, even consumer pushback starts to happen. And I begin to wonder, if that dominance is going to last. Like in Europe, I know they're starting to create a sort of like Euro centralized payment system to compete with a Visa, MasterCard, for instance. We've seen these BRICS, the special currency, the digital currency to compete with Bitcoin, et cetera. So, sometimes these businesses or at least their industries become so strong that inevitably there's going to be pushback. So I tried to pick 4 that I think are kind of safe from that. No Visa, MasterCard. I own both of those companies. I expect to own them for a long time. They are a monopoly, but I'm not going to talk about that today. I'm going to talk about 4 companies that I think are probably safe buys right now and that will, maintain that market share dominance for a long time. So up first, we have waste management, turning trash into cash. I've talked about this on this show a bunch. I love this industry. Between Waste Management, which is the largest North American trash collection company, Republic Services, and then Waste Connections, these 3 companies in the U.S. have a 75% market share. So we talk about, size and scale. Well, they dominate it. There's a lot of regulatory kind of issues that these trash collection, disposal, and storage companies have to deal with. You can't just create piles of garbage out in the woods somewhere. You have to dispose of it correctly. You have to be environmentally safe. And that's what these companies do. So Waste Management is the largest. They're one of my largest personal holdings because I just can't imagine a future where human beings are not going to be paying for somebody to take away their garbage and, responsibly dispose of that. AI, we talk wars, no matter what happens, right? You've got to take your trash away. We're always going to be making trash. So this company is currently trading at about 30.5 times earnings. So kind of pricey, but that is in line basically with the 5-year average. That was kind of what I did here. I'll put up a fast graph now. You can see the jagged black line is the current share price. The blue line is the 5-year average, which is 28.9 times. And then the pink line is the 10-year average. So I added the 10-year average in here too. So you can kind of, take, what if the post-COVID market isn't what you want to compare to? What if you want to get some pre-COVID exposure too in that valuation? So that is, what do we have here? 26.8 times. So relative to that 10-year average, Waste Management looks pricey, but on a forward basis, 28.9 times the expected 2026 earnings, of $8.26 is basically $237 a share. Today we're at $235. So not a big discount here, but as Warren Buffett said, there's nothing wrong with buying a wonderful company at a fair price. If you sit back and wait to buy Waste Management at 20 times, you're never going to buy it, right? In COVID, it dipped down to right about 20, and that was a generational sell-off. And then you've got to go all the way back to like 2014, right? So if you want to wait for those, once in a decade, once every 20-year moments to buy this company at 20 times, like, more power to you. That purchase is going to generate you a great return. But I think you can do just fine buying it, 28, 29, 30 times. It compounds at about 10, 12% a year annually. It's got a 1.5% dividend yield, high margins. It's consolidating an industry. The Waste Management Republic, they keep buying these kind of mom and pop, like local or even regional trash companies. So they're going to keep growing. The revenues are going to keep happening. 17 out of the last 20 years, they've grown their EPS. And then it was 4 double-digit EPS growth years in a row prior to 2025, where there was some inflationary issues and some restructuring problems. But love this company, 30 times earnings. Think it's a fair deal. I think in 10 years, you look back on this one, you're not going to regret owning it. So there's my first pick, Brad. Waste Management. Like I said, turning trash into cash. Kind of one of my favorite ways to collect dividends.
Yeah, I'll tell you an interesting hometown story. So I'm based in Spartanburg, South Carolina, and there's a very successful businessman, entrepreneur, investor here. And many years ago, he sold his waste management business to Waste Management, and of course, Wayne Huizenga was involved with Waste Management, and that deal led to another deal called Blockbuster Video. The same group became the largest franchisee of Blockbuster Video, another Huizenga company, and they successfully monetized that portfolio of Blockbusters. They became the largest franchisee, actually went into the management position at Blockbuster, and then they started another business. Once they exited that with a pretty significant payday, they started a company called Extended Stay America, which also was Huizenga was involved in that deal, which was very successfully monetized, I believe, to Blackstone. And it's been a really successful story, but it all started with that trash to cash, Nick. So, really interesting pick. And I agree. That certainly has a lot of monopoly traits. The one I'm going to talk about right now is another one that kind of was inspired for me from another billionaire by the name of Bill Ackman. Of course, many of you know I met with Bill last year. Actually, I got a tweet from him over the weekend, believe it or not, a direct message tweet. So I do have a dialogue with Bill Ackman, but he's also an investor in Brookfield Asset Management. That ticker symbol is BAM. Now, of course, most of you know this is the capital allocator monopoly we're talking about. Brookfield is not your traditional monopoly. Instead, it controls far more valuable global capital flows into real assets. This is a company with over a century-year of history, but its real strength comes from the platform it's built. So let's break it down. First, we have scale. Brookfield manages hundreds of billions of dollars across real estate, infrastructure, renewable energy, and private equity. Second is access. Because of its size and reputation, Brookfield gets to access deals that most firms never, ever see. It partners directly with governments and major institutions. This Brookfield ecosystem has over $1 trillion of assets under management and 250,000 operating employees. This gives the company an edge in sourcing, execution, and value creation through market cycles. Third, we have the capital advantage. Brookfield uses long duration, patient capital that doesn't need to be returned quickly. That allows it to think long term and act when others can't. All of this creates a powerful flywheel. More capital leads to better deals leads to better returns, and better returns attract even more capital. On top of all of that, Brookfield has shifted towards a fee-based model, meaning it's earnings recurring income simply for managing assets. This isn't just investing, it's owning the system that allocates capital. Now, in terms of the latest results, this is the fourth quarter, the company generated fee-related earnings of $867 million. They grew that by 28%. Distributor earnings grew by 18% year over year to $767 million. During the full year, Brookfield raised a substantial $112 billion of capital and deployed a record $66 billion into high-quality assets across its core sectors. Now, the company has an A- rated balance sheet that supports a long-term debt-to-capital ratio of 21% and $3 billion of corporate liquidity. Now, as you can see from this fast graph, Brookfield is trading at $44.45 per share with a dividend yield of 4.5%. The earnings multiple today, based on a PE multiple, is 26.6 times compared with the normal valuation of around 30 times. Now I'm going to put a second chart up here, which is our forecasting chart. You can see here, even in a little more conservative outlook, I've forecasted Brookfield Asset Management, BAM, to generate earnings of around 30% annually. So this is a company here that has a wide moat. They certainly have a monopoly in this sector, and they're trading at a nice wide margin of safety. So anyway, Nick, what are your thoughts on Brookfield, if you have any?
No, I like this company. I was sad to see Bruce Flatt retiring from CEO. I think he's just going to be the chairman. That was like February of this year, because this used to be one of those companies like you're just buying into Bruce Flatt, who many people called like the Canadian Warren Buffett. He built this wonderful asset management business. I like the Brookfield kind of suite of stocks too, because you can kind of tailor it to your own needs, right? You can go with ticker symbol BN. That's a lower yielding, faster growing company. They just collect fees they're like the overall umbrella. They collect fees from all the underlings. You got BAM, which is kind of in the credit alternative assets, and you've got the Brookfield renewables, if you want to just focus on that, the infrastructure, if you want to focus on non-renewable infrastructure. So it's complicated. Like they don't make it easy on you, but they do. If you want to do the work, and if you kind of want to really know what you own, you can kind of pick and choose, which is nice. And everything besides ticker symbol BN has a nice high yield, and like you mentioned, just pretty reliable dividend growth. So it's hard to find like a 4 or 5% yield with 7, 8, 9, 10, even like you said, 15% dividend growth. Well, these tickers offer that, or at least they have in the past, and I think they will moving forward. So like the Brookfield companies, I've owned all of them in the past, and right now I'm out of them, kind of for newsletter issues, but they're great companies, no doubt.
Great. Well, I can't wait I know your next one. I'll give everybody a little hint. I use this every single day.
There's the moat right there, right? You're not the only one.
Exactly.
Yeah, so Apple, we'll go with Apple. Brad spoiled it. Brad's got his iPhone. Here's mine, right? 2.5 billion active devices right now. So that's their global install base. That's a massive scale moat. And then over the last decade, they've really monetized that. They make a ton of money selling phones. Much of that's kind of subsidized by the wireless companies that need us on those phones to collect those monthly, internet and phone bills. So that's a great business in itself, where the customer doesn't even have to buy it. I think Apple's got a lot of pricing power. A new phone's like $2,000 now, but we don't even know that, right? Because we just pay like $23 a month to Verizon. You don't even think about it. You just, like, how often do you go to a store and you make a $2,000 purchase and you don't even care? This is the only one really. But we all have to have it. People love the Apple ecosystem. In terms of market share, I think Apple's at like 45% globally or something like that. Actually, sorry, I have it here. They're them and Samsung combined are like 45%, but they're one of the largest players. Like I said, 2.5 billion active devices. That's up about 150 million over the last year. I don't consider this really a tech company. I've said this on this channel before, and people think I'm stealing this idea from Warren Buffett, but I think I had it first, right? I think he didn't steal it from me, obviously, but I think I beat him to the punch. I could just consider this company like a consumer staple company. They're like the Coca-Cola of the 21st century. They're all over the place. We have to have them. We can't do without them. We pay all these little fees. I pay Apple, $2 a month for my phone, for my picture storage. I pay them for music. I pay them for all these different things. I don't think twice about it. And I've owned this company for a long time. I've owned them since like 2012. It's a 10 plus bagger for me. And it's one, I've trimmed it in the past and I regretted it. Thankfully there's small trims. It's still my third largest holding, and I'll probably never sell another share. The dividend increases about 4 to 6% a year. I wish they would be more aggressive with that. They're not, but they're not, because they buy back, hundreds of billions of dollars worth of shares. So they are retiring shares. They're not one of these companies that announces an $80 billion buyback and then they return 80 billion in share-based comp, and it doesn't really impact the investors. They have significantly reduced their share count over time. So I can put up a chart for macro trends showing that. Love those kind of down and to the right trends with regard to outstanding shares. Dividend up and to the right. With regard to capital kind of shareholder returns since Tim Cook took over, here's a chart from Apple's investor relations page. And it's just incredible, $1 trillion+ of shareholder returns. There's not very many companies that have done that. And from a valuation perspective, very similarly to Waste Management, I think the valuation here is probably fair. There's no discount. Apple's certainly not cheap. It's trading for 32 times. It's growing 14% this year, 10% the next couple of years. On a forward basis, 30.5 times is the 5-year average. That's 258. Shares are at 256 right now. So basically right in line with fair value. This one, like the long-term fast graph, I'll show the 5-year fast graph. Same here. The pink line is the 10-year average. That's at 23 times. If you go out to the 20-year average, it's super low. It's only, it's like 22 times. And that's because prior to their shift towards a SaaS business, when Apple was only known for selling hardware 10, 15, 20 years ago, they're trading for like 15 times earnings because this was a hardware company, but they transitioned into being a software company. And then interestingly enough, I think they may have taken the best stance in kind of in the new AI age, right? They did just fine in digital and in cloud. People were so worried that Apple had thrown away its 5-year head start with Siri. They're not investing hardly any money. Google, Amazon, Meta, all these companies are spending $100 billion a year in CapEx. Apple's has not increased at all. They're just still doing their normal R&D, their normal CapEx. And I like the approach. People were worried that this was not it, but I don't know which AI is going to work. I don't know which large language model is going to have the best ROI, et cetera. A lot of companies are just burning cash trying to figure that out. Apple is not. They're licensing Gemini right now from Google. So sure, they're paying Google some money here, but that's okay, right? I think it's a lot less money than they would have had to kind of throw down the toilet, for lack of a better term, trying to compete with all these other big LLM names. OpenAI, we've seen their CapEx spend projections go down. Like, it's just a lot of these things, the ROI is not happening in the AI like we thought it might. So I think in 5 years, people might look back on Apple and say, hey, they had the right idea, right? Just sit and wait, license the winner, have the best product, just like they always do. This is a boring company. This is not an exciting company these days, but I'm happy to pay 30 times here. Happy to own it. 0.5% dividend yield. I just wish that was growing faster. That's my one gripe. Like, if Tim Cook or if Apple management's watching the Wide Moat Show, just do what Microsoft does. Give us 10% increases a year, and then I'll never have anything bad to say about this company again. So that's my number 2 monopoly, Brad. Apple with that huge global install base.
Yeah, I guess hopefully Tim's watching today, but if he's not, another angle, and I know I mentioned this last week, you can always buy a data center REIT or a REIT and pair it with your Apple to get your income. Obviously,
Yeah.
REITs pay out higher income, higher dividends. But my next pick is not a REIT right yet. I'm going to first move over the Monopoly board to American Waterworks. That ticker symbol is AWK. Now, this is a true legal monopoly. If you want to understand what a real monopoly looks like, Nick, just look at your water faucet. America Waterworks is the largest publicly traded water utility in the U.S., serving more than 14 million people. Its advantage is straightforward and incredibly durable. It operates in exclusive territories where competition is not allowed. It owns infrastructure that is nearly impossible to replicate, and it operates under a regulatory system that provides stable, predictable returns. Water is essential. Demand doesn't drop in a recession. Growth comes from acquiring smaller, fragmented systems across the country, upgrading them, and integrating them into their network. This is not a high growth business, but it's consistent, durable, and built to compound over long periods of time. Now, last fall, the company announced a merger with Essential Water. That ticker's WTRG, and that will unite two of the largest water utilities in the country. That will provide more geographic diversification, as well as obviously more customers, and it'll give American Water Works access to markets like Texas and North Carolina. Longer term, the company has over 1.5 million customer connections in its pipeline that can selectively acquire in the future years. Now, in terms of the fast graphs, I want to point out here, I think that American Water Works is going to be able to continue to grow by about 8 to 9% per year. You can see on this fast graph here that I've got the share price at about $138 roughly. The current multiple is about 23.9 times. Now that's compared, the reason that black line is below the blue line is the normal valuation on fast graphs. And that blue line represents an average multiple across that time frame of about 28 times roughly. So you have a 23 or 24 multiple, a 28 times normal trading multiple. And in terms of growth, you can see in this year, 2026, we believe the company should be able to grow by around 7%. And in future years, you can see that also on the fast graphs, about 8% in 2027 and about 8% in 2028. Now, I've also included another fast graphs, which is what I call the kind of forecasting. It's kind of the crystal ball, I like to say, or my friend Chuck Carnevale, who owns fast graphs, would always say, this is your crystal ball. You can kind of say, what if this happens and this happens? So what I do with these forecasting tools is I look at I'm not forecasting a return to normal valuation. I want to have really what I call a most likely, not an optimistic or not too pessimistic, but a most likely forecast here, which is below that normal value. And then obviously you get the benefit of the growth, of the 8% growth next year, 7% this year, as well as the dividend. So that puts you in about a 20% total return. By the way, that dividend yield is about 2.4%. So when you combine all of those pieces, the sum of those parts is, I believe American Water Works is a monopoly pick that could generate about 20% annualized returns over, say, the next 12 months. Nick, any thoughts on the very boring sector of water?
No, yeah, I love this. It's very similar to the trash, right? You can't live without it. This company keeps consolidating its industry. I think the trash industry is like a couple decades ahead of the water industry as far as consolidation, but I'm sure, in flash forward to, 2040, and it's going to be the same thing. It's just going to be 2 or 3 companies that kind of dominate this. And, this is regulated. Trash is not. That's the difference. But, I love it. A high single digit earnings growth, like you said, 2% dividend yield, that in itself should point towards about a 10% return. And then when you're able to buy it when it's undervalued, you can kind of boost that with multiple expansion. So nothing bad to say about this one. This, like you said, it's boring, right? But in today's kind of volatile environment, boring is maybe probably what most people are going to kind of gravitate towards anyway.
Well, I'm glad this one passes your smell test. Water doesn't smell. Of course, we know what trash smells like. So
there you go. Well, it shouldn't smell, but yeah, that's yeah. So we'll move from a boring company. This one is pretty exciting. I'll talk about ASML. If you Google biggest monopolies in the world, this one's probably at the top of the list because they are essentially the only company in the world that do what they do. And what they do is necessary for everything that happens basically in our lives, right? So they create these massive machines. I Googled it. They weigh between 150 and 200 tons. They're the size of a double-decker bus. They have over 100,000 parts in them. They're these hugely complicated machines, and then they use laser beams and ultraviolet light, etc., to create semiconductors. So Taiwan Semiconductor, who is another name I strongly considered kind of for this pick, they have this sort of geopolitical risk I'll just avoid. I know a lot of people just see TSM shares, and they, no matter how great of a company that is, they don't want to own it because, what happens if China decides to invade? I don't know. The share price probably gets cut in half, if not more. That'll be a massive problem for the world, though, not just for TSM, because everybody uses those chips. And those chips are made with the EUV machines made by ASML. So I've seen headlines where like, Chinese espionage and things like that. There are some people that wonder if a Chinese company, for instance, would be able to recreate this technology. ASML CEO has said, I think there's like, they're 2 to 3 years out from any competition on current generation models. And obviously they improve over time. So I don't know where that is. That would be the one argument that, this is a monopoly at the moment, but there could be a lot of people trying to recreate these massively complicated machines that ASML sells to people. The downside is also these are very expensive machines. They only have a few customers, right? Taiwan Semi, Intel, etc. So that's maybe a problem. If Taiwan Semi says, "Hey, we got enough EUV machines," the ASML's in trouble because nobody else is going to buy them. But looking at the fast graph, that hasn't been an issue over the long term. Very consistent growth. It's been somewhat cyclical. When semis, aren't hot, then these big machine orders go down. But generally speaking, this is compounded at a very fast rate over the long term, especially since COVID, where we've seen the kind of AI race take off. It grew 45% last year, is expected to grow 17% this year, 31% the year after that, 19%. So, it's a pretty jagged earnings growth numbers, but most of them are positive. Looking at the 5-year chart here, just like I've shown on a forward basis, we're just right in line with the 5-year average. 5-year average is 38.6 times. That would be $1,315. Shares are at $1,317. I'm not going to, be upset about paying an extra $2 on a $1,300 share. This is just one you just buy it and own it for a long time and just make sure that there's no major disruption. I can't imagine a future where semiconductor demand it slows down really. And with that said, all of the most complicated semis in the world are built with these machines. So ASML, third monopoly. Once again, low dividend yield, but they are more generous with their dividend growth. This is a double-digit dividend grower. Just be aware that they're on like the European model, so they don't pay quarterly. They pay semi-annually, and then usually one's much larger than the other. So I do wish Europe would kind of get on board with the American model with regard to more reliable dividend growth and more predictable dividends. But the dividend line at the bottom of this long-term chart is trending upwards, and I expect that to continue moving forward.
Well, Nick, I don't know if this is the American model or not, because there's been some of the folks want to have earnings reports every, I guess,
Yeah, it might be changing. I've seen that. Yeah, they want to I get it. I guess you save money. You don't have to pay people to do your quarterly earnings if you only have to do it every 6 months. But I don't think that they're going to change the quarterly dividend payments, even if that happens.
Yeah.
I haven't followed that. I don't know if you track that. I saw Trump was talking about doing that, making it just like a biannual review instead of a quarterly. I don't know whatever happened to that or if that has support in Congress or not, but
yeah, I haven't seen it pop up lately, but of course, as I want to see monthly dividends, and I think I was successful at having a few of the REITs that I've covered over the years, like Agree Realty, for example, and like Stag Industrial. I pounded the table for those companies to pay monthly, and now they do. And in fact, I'm going to pound the table here for this next pick. This is my REIT for the day. EastGroup Properties. This is the local logistics monopoly we're talking about. Much more quieter story, but a really powerful story. This company focuses on small bay industrial properties. It's what I call flex space. And these are located in high growth Sunbelt markets like Texas, Florida, Arizona, and California, as well as Greenville, Spartanburg, South Carolina, and Charlotte, North Carolina, all right here in my backyard. Now, these aren't massive warehouses like you're going to see at Prologis. In fact, I was thinking about putting Prologis in here, that's ticker PLD, as my pick, my monopoly pick. But I decided to go with EastGroup primarily because I wanted our audience to be able to act upon it. And I think there's some value right now in EastGroup. Prologis is about fairly valued here. So anyway, EastGroup, they're a smaller space landlord, and they focus on these last mile logistics. Typically, the customers rent between 5,000 to 50,000 square feet. Now, their edge comes from the focus and discipline. They operate in these infill locations where land is extremely scarce and difficult to develop. They serve tenants who depend on proximity to their customers, making them less likely to leave. As they build density within their markets, they'll create local dominance and operational efficiency. Instead of trying to be everywhere, EastGroup focuses on doing just a few markets really, really well. That's what creates the pricing power and long-term stability. Now, that's reflected in the latest earnings we saw. In the fourth quarter, their FFO rose by almost 9%, 8.8% to be exact. That's year over year. And for the quarter, they grew FFO by about 7.7%. This marks over 10 years of FFO per share growth, signaling the durability of the business model across all business cycles. Occupancy is strong at 96.2%. They increased that 40 basis points over the last period. Now, given the strong releasing rates and development pipeline, I expect EastGroup to be able to deliver 7 to 8% annual FFO growth in the midterm. Now, I've got this fast graphs here, and you can see shares are right now trading about $188 per share. Again, the price to AFFO multiple is 27 times. The normal valuation is about 28 times. Again, looking at that fast graphs, that blue line is the normal valuation utilizing the price to earnings multiple of 28 times. And the current multiple is about 27 times. So we've got a slight margin of safety there. Not huge, but definitely worth buying. Again, Prologis was a little more expensive than I wanted to recommend here at the Wide Moat Show. Now, in terms of their growth, analysts are forecasting 10% this year, AFFO, and 7% in 27, 8% in 28. Now, I'm going to flash up one more chart. Again, this is this forecasting chart, which I like to, again, call it my crystal ball, if you will, or what Chuck Carnevale would call it at Fastgraphs. You can see here, I'm forecasting, trying to be a little more, again, most likely, not conservative, not pessimistic, of about, again, 20% annualized growth. So I think you've got a real opportunity here. The dividend yield is about 3.3%. Again, the growth is about 7, call it 7% next year. That's 10. And again, we have about 10% discount to current valuation. So I think you're looking at about a 20% total return. EastGroup, not a bargain, but definitely a true monopoly right here in my backyard here in South Carolina. Nick, any thoughts on this one?
No, I mean, you keep talking about these 20% returns, have at it. That's awesome. I like this. It's interesting space. Like Prologis, everybody knows what those warehouses look like. They're massive, typically own Amazon, Walmart, etc. This flex space is more interesting to me, I think, because you can get higher returns in a more customized, contracts. These are kind of individually leased, systems like smaller mid-sized businesses. So I like to pair it with a Prologis, obviously, and that's a nice, those two companies would cover all of your warehouse needs in your portfolio. I think I've been kind of boring with all my picks so far, trading right in line with fair value, very high quality companies, relatively limited upside because of that. This last pick could have massive upside, but also a lot more risk involved. So this is not a stock that I own, but it's one that I've been doing a lot of work on recently, and I may add it to my portfolio moving forward. And it's the Fair Isaac Corporation, ticker symbol FICO. The FICO scores that you need when you go get a mortgage, buy a car, go to the government, get a loan, etc. For years and years and years, this was clearly one of the best companies on earth. When we think about monopolies, I think about two things really. I think about pricing power, the ability to increase prices without decreasing demand. And then I think about operating leverage, which is when your revenues increase, your margins actually go up and not down because of the fact that it doesn't cost any more money to expand your business. Brad and I are in the newsletter business, huge operating leverage. We love that, right? I'm writing the newsletter every month, no matter what. And Brad's paying me to do that. So the more people reading it, the better for us, the more people paying for that newsletter. FICO was doing that for years and years and years with these credit scores. And they actually kind of became like a government created monopoly because for a long time, you could not get a government-backed debt without a FICO score involved. It was required in the contract. It made sense for the government. They want to make sure that the people they're doing business with are, good businessmen, good people, etc. Well, FICO benefited from that. And 10, 20 years ago, we're talking pennies. It didn't cost very much money at all to get your FICO score, to get your report, to check your credit, etc. Well, then kind of what this company did is they started to aggressively increase prices. Now it's 10, 15, $20 to when you do your mortgage to get your FICO score. And then also you can pay them, $19 a month to kind of get these recurring revenues Brad's talking about to do credit monitoring. So they have drastically increased the price of their offerings. But the thing is, the offerings are the same. They haven't increased the quality of what you're getting. You're getting the same thing. You're getting information. And that's why, looking at this fast graph, this stock has sold off drastically, because what's happened is the government no longer mandates that you have to have a FICO score. They actually kind of created a competitor. And then other competitors, now that it's not mandated, are coming in. Everybody wants a piece of these margins. They're very high margins, but it's not mandated anymore. So FICO's argument for a long time has been, well, if you're getting a $500,000 mortgage, what's $25 to check your credit, et cetera. Well, it used to be 25 cents. And eventually, as these prices have gone up, there's been more pressure put on this business from a regulatory standpoint and from a competition standpoint. But as you can see from the fast graphs, not an earnings standpoint. So shares are down more than 50% from their 2024 highs. This was like a $2,500 company back then. We're at $1,100 today. Massive sell-off due to increased competition, one, and also the idea that maybe AI can do what they do, right? And if that's the case, then do we even really need a FICO business? Kind of the same argument that people have made against S&P Global and Moody's. I don't think it's a good argument. I think those companies will be around. This is a more like consumer-centric credit-based check. But as you can see, 39% earnings growth expectations this year, 27 and 18. So yeah, sure, it's slowing, but it's still strong double-digit growth. And we're down to 30 times earnings now. This was in October 2024. This company is trading for 83 times. I think it was clearly overvalued then. I feel sorry for anybody that paid that sort of multiple. You saw this huge run up in 2024. That's like a complete FOMO situation. But now it's the opposite. Now this is all fear. There's no buyers for this stock. It's just been precipitously selling off. And maybe it'll keep going. The problem with this is you're catching a falling knife. I have no idea where the floor is going to be. But if you look, this kind of 30 times level has served as a pretty good floor for the stock in the past during the COVID sell-off in 2022, from 2015 to kind of 2019. This is kind of where the stock traded. So if we're looking at it in 2023, 2024 and saw, man, I wish I owned Fair Isaac, but I'm not paying 50, 60, 70, 80 times. Well, today you've got a chance to buy it at 30, right? There is increased competition. There's AI threats. There are people looking into the pricing and saying this is a monopoly. It might have to be broken up. It may have to be regulated, et cetera. There are a lot of headwinds. 50% plus sell-offs on businesses that there's been no earnings growth disruption, right? Like, look at this: 17, 18, 15, 64, 30. Every number on this chart is super positive and the stock's down 50%. That's because of a perceived threat to the business. I don't know if it's going to happen or not, but from a risk reward standpoint, if we go back up to the 40 times level where this stock is kind of averaged in the last 5 years, you're looking at $1,700 stock. So you're looking at 60% upside, in the next year. I'm not calling that shot. I don't think we're going to see that huge mean reversion right away, but eventually I suspect the sell-off will end. We'll find a floor, et cetera. And when that does, the fundamental growth should just take this stock, up and to the right, just like it's done for years and years and years. This has been one of the biggest winners here. What do we got? 10-year chart. It's up 900% in the last 10 years. And it's up 11,000%, since 1996. I think that's the IPO date here, looking at long-term data on Seeking Alpha. So this stock has absolutely printed money for investors for decades. It's down 50% plus. I still think it's a monopoly, but it is being challenged for really the first time in its history. So interesting pick here. Let me know what you think in the comment section below. Are you buying into FICO, or do you think the risk is too high? I've been kind of wrestling with that myself. So, if I buy it, I'll let you guys know, certainly in the future. But it's very interesting, to say the least.
Great. That's a good pick, Nick. And I'm going to end on perhaps even the most speculative monopoly pick on the board today. So I want to reiterate, this is a speculative pick. And it's a company that I know really well, going back to my roots in commercial real estate for over 2 decades. This company is called CoStar. Ticker symbol is CSGP. The company has a data monopoly. Now, CoStar may be the most interesting of all of these that we talked about today because it doesn't own real estate. It owns the data behind it. CoStar built one of the most comprehensive real estate databases in the world by collecting, verifying, and standardizing property-level information. Its advantage comes from 3 specific areas. First off, the proprietary data. It employs thousands of researchers to maintain real-time, high-quality information that is extremely difficult to replicate. Now, I know this is part of this software sell-off, but let's go on to the next monopoly advantage, which is the high switching costs. Brokers, investors, and developers, just like I was, rely on CoStar every day. I've got many, many friends who utilize CoStar every day throughout the day to help performance for their brokerage or investments, etc. In fact, I'm looking at a deal right now where I wish I had CoStar because of the data that the company has. Once the CoStar is integrated within the workflow, it's very hard to replace. Now, the third monopoly is the network effect. As more users join, more data is created, and the platform becomes even more valuable. On top of that, platforms like LoopNet, Apartments.com, and Homes.com expand the reach into marketplaces and advertising. So in many ways, CoStar controls the information layer of real estate. Now, take a look at this fast graph. So you can see here, first I'm going to put 3 fast graphs. The first one, I took the price off. I just wanted to see earnings. Now, when you look at this first chart, you can see earnings going all the way back to 2006 and pretty upward transition going up. And then, of course, you can see in 23 and 24, there was a sell-off in terms of their earnings, which is now kind of, I guess we'll call it normalized. But what's really telling is the growth forecast of the company. You can see 2026, consensus growth of 48%, 2027, 37%, and 2028, 26%. Now, the next fast graph I'm going to show you, I put the black line back on here and the average multiple, and you can see shares have just really fallen. Now trading at about $39.95 a share. The multiple is about 40.9 times compared with, we'll call it the normal multiple of about 69 times. So pretty significant drop. Now, this company does not pay a dividend. And I also want to mention, again, this is more speculative. There's been some activism within the company. And also want to point out, I'm going to be doing a deeper dive at Wide Moat Research. So you can check into widemoatdaily.com and get all of our free news. And I'll be writing on CoStar in the near future. Now, the forecast chart or the crystal ball. Again, if they move not even into their most pessimistic forecast, I see CoStar returning potentially 60%. If this were a small cap, which it's not, share is a almost $17 billion business here. But if it was a small cap, I would definitely consider CoStar in my Wide Moat Confidential product, which is our small cap newsletter we have at Wide Moat Research. But again, this is a $17 billion company, very speculative, but really significant opportunity. So I'll be doing a deeper dive on this one. And this pretty well sums up the weekly show here. So tying all this together, these companies don't really compete on price. They compete on control of capital, control of infrastructure, control of location, control of data. That's what creates a real moat. So I hope you've enjoyed this edition of the 8 monopoly-like stocks for the week. And we look forward to having you back again. And Nick, I'll let you sign off here for today.
No, that's it. We're 45 minutes in, so I'm going to be quick. Thanks for stopping by. Give us a like, subscribe, etc. if you enjoyed this show. Let us know what you want to hear us talk about in the future in the comments section. We always read those comments. We do our best to reply to them, and we will certainly take your recommendations into mind when Brad and I plan out future shows. So, a lot of buys on the list today. So some undervalued companies, some fair valued companies. In today's market, the market's dipping. Everybody's looking for things to buy. I think you should target monopolies. When the world's kind of falling apart, the sky's falling, gravitate towards the highest quality businesses in the world and I think you'll be fine long term. So thank you guys for stopping by, and we'll see you next Thursday.